Welcome to the Lend Academy podcast, session number 33. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Brock Blake. He is the CEO and founder of Lendio, which is a small business lending marketplace. Now, it's no secret that I'm a huge fan of small business lending. I think it provides a great return to investors. It provides a win for the borrowers as entrepreneurs get access to capital that historically they probably wouldn't have been able to. And so on the show today, we're going to talk about the kind of entrepreneurs who are using Lendio to apply for loans, about a really big deal that they just signed up with one of the major office supply chains, and as well as a couple of surprises. Hope you enjoy the show. Welcome to the podcast, Brock.
Thanks, Peter. Excited to be on today. You've done a great job with other podcasts, so I feel honored to be here.
Okay, well, thank you. Why don't we get started by just giving some of the listeners some background about yourself, how where you've spent your career and how you came to start Lendio.
Yeah, so I've been an entrepreneur all the way since school. I went to BYU actually, and studied entrepreneurship and finance there. And interesting enough, to start my entrepreneur career, I did an entrepreneurship contest, kind of like the TV show The Apprentice. There was about 100 applicants. They narrowed it down to 20, and then the 20 of us went through this 8-week boot camp, and where we did a sales competition and we did a fundraising competition, and we didn't have all the glitz and glamour that the Apprentice has, but at the end of this 8 weeks, there was 5 of us that won $50,000 to be able to start a business. Wow,
that's fantastic.
So yeah, I was one of those winners and had $50,000 and sought out to solve a problem, and we started the predecessor to Lendio was a company that focused on connecting entrepreneurs to angel investors and venture capitalists. And we figured out very quickly that there was a lot of demand from the entrepreneurs, but it's kind of the angel list of sorts back in the day. Mm-hmm. But there's only a small percentage of entrepreneurs that are actually going to raise money from angel venture capitalists. And so, but we had all of these business owners coming in, these Main Street business owners, restaurant owners, and landscapers and dry cleaners, and we realized the market was enormous and the demand for financing was incredible, but focusing on kind of this equity funding was the wrong approach. And that's when we decided to start adding kind of some of the debt financing components to it, getting bank loans and lines of credit and business credit cards, and that was kind of the early days of this debt financing market, and we learned a lot and launched Lendio in 2011.
Okay.
So that's kind of the shortened version of that background, but
sure.
So.
Okay, so then what? Can you just explain exactly what Lendio does?
Yeah, so Lendio, we are not, contrary to a lot of the other lenders in the space, we are not a direct lender. We are a marketplace for other lenders. So one might think of us as maybe a kayak for small business loans or something like that. What we have done is aggregated the best-in-class lenders across all the different loan product categories in small business into one platform. So we have, OnDeck and Cabbage and DealStruck and Funding Circle and all of these lenders into one platform. So when a business owner is looking for financing, instead of going, lender to lender to lender, trying to figure out which option is the best fit for them, we've aggregated them to make it an easy and positive experience for that business owner. What's unique about small business lending is that, maybe in consumer lending, there's 2 data points you really need to underwrite a loan. And I'm not saying that's easy, but the 2 data points of credit score and income, almost every consumer in the U.S. has those 2 data points, and so you can target anyone in the U.S. In small business, it's very different. So many different profile characteristics of business owners, so many different ways of underwriting. In fact, there's about 25 to 30 different types of business loan products out there. And so if you're a business owner, and let's say you're a restaurant owner or a landscaper or dry cleaner, and you're running your business and you're juggling, all of these different balls in the air, it's really difficult for you to try to become an expert at all the different options that are out there. And so, to try and understand between accounts receivable financing, merchant cash advance, cash flow loans, SBA loans, equipment loans, and so on. So what we've done is created this technology where we make that process simple by bringing all the options together in one spot for that business owner.
Okay, so then how do you do that in a way that, are you making a judgment call where someone comes along there, just say they're like a manufacturer and they need a new piece of equipment and they need it quickly, and are you going to make the call based on your inputs and say, right, you could do an equipment finance loan, but you really need this fast, so maybe you should go and look at like an on deck or something. I mean, how are you making that judgment call?
Yeah, so we use, technology system. We use a tremendous amount of data points. We're using kind of, people like to call machine learning or whatever it might be, where when a business owner comes in, we're gathering information. Let's say we pull their credit and we pull bank statements and we're analyzing this data. The first thing we're going to do is identify which loan products they're a good fit for. So the main categories. And then from the categories, the second step is, out of all those categories in which they could be a good fit for, which are the best lenders that are most likely to get them approved for a loan. And then we've aggregated it to this small group of lenders where we know these business owners are going to be a good match for these 4 or 5 lenders. At that point, our process is to gather the full application requirements for each of those lenders. We've pulled, let's say again there are 5 lenders. We've consolidated their full application of those 5 different lenders and all the data requirements for those 5 different lenders into one standard application form. We gather that data from the business owner, and then we submit those applications to each of those 5 lenders, at which point those lenders underwrite the loan and either make an offer or decline. And once those offers are pulled together, let's say 3 out of the 5 gave an offer and 2 of them declined. So then we'll take those 3 offers back to the customer and say, okay, you've got, and they may be an equipment lender, and you might have a merchant cash advance lender, and maybe you've got a commercial real estate loan. And we put those 3 options on the table for that business owner, and we really want to allow them to decide which is the best fit for them. And sometimes it may be, like you said, maybe it's a short time frame, so I want the deal that's going to close within the next 2 days. Or maybe it's, hey, I want the largest loan size, so I don't care, I have got time to spare, but I want the loan with the largest that will offer me the most amount of money. Or maybe the third option for that business owner is, I want the one with the lowest rate. So I've got a little bit of time, and so I'm going to take whichever one will give me the lowest rate. Our job is to get them the best offers and then allow them to decide which makes the most sense for them and their situation that they're in.
So are you finding business owners, don't always take the best rate? I mean, what's the, you talked about 3 different scenarios there. Which one is most popular?
That's a great question. I mean, I think people assume that rate is always the number one priority. And it is a high priority for a lot of business owners, where they're just shopping for rate. I'm just trying to get the best rate out there, and that's what's most important to me. But you find that there's so many business owners out there that care. I don't want to say they don't care about the rate, because everyone cares about the rate. But what's higher priority for them is the speed to funding or the loan size. And it's hard to be able to have all 3. You can't say, all 3 of these are really, really important to me, where I get the most money for the lowest rate and the fastest time.
Right.
There's just not that many lenders that are able to kind of do all of that. And so, it's hard to say what is the number one, the most popular. I actually think speed to funding is higher priority for business owners than the rate is, but loan size obviously plays into that as well.
Right. I also imagine, you say you work with SBA lenders too. I imagine that the speed of application would be a factor as well, because, I mean, you go to a bank and try and take out an SBA loan application can be quite onerous. Are you finding that as well with the entrepreneurs coming to you? Are they also impacted as far as what they have to actually submit to do an application? Because I imagine someone like On Deck or Cabbage, which is fairly, they have a lot of automation, is different than an SBA lender who is going to take their sweet time over a decision. I mean, so I guess my question I'm getting at is ease of use one of those factors, to ease of the application process?
Yeah, there's certainly no question about that. I mean, what's nice about some of these more innovative lenders, you mentioned On Deck, you mentioned Cabbage or Can Capital, they're very, very focused on that user experience. They're focused on creating technology where the underwriting actually happens within minutes. And so, because we've built APIs into these lenders' underwriting systems, I'd throw strategic and merchant cash and capital in there as well. You build these APIs, and now within a matter of seconds, that borrower has a full, offer through one of these lenders, and that can fund later that afternoon or the next morning, before an SBA lender has even taken a look at the application. And so certainly that's attractive, especially if they could take that loan or that offer and get it funded now. And maybe what that does is buy them the time to actually get an SBA loan, 30 or 60 days down the road. Because now they're not in so much urgency, they're going to pay a little bit more now, but it gives them that time to go through that full lengthy process that is an SBA loan.
You help them through that SBA loan process, I presume, as well. So you might get them a loan that might be from one of the other, from Cabbage or On Deck or Can Capital or what have you. But you might still work with them and say, right, the SBA loan is going to be it's going to be your cheapest cost of capital. So you will help them do both. Is that what you're saying?
Yeah. Yep. Then there's no question about that. So fortunately on the SBA side, there's lenders out there and platforms that are really trying to shorten that time frame and create innovation around SBA loans so it's not such a long process. SmartBiz is kind of out there leading the way. Celtic Bank is a national SBA lender that's really focused on efficient process using technology. Financial Pacific is another bank that we work with that also does, is aggressive on the SBA side. Superior Financial Group is another one. And it's coming from the SBA themselves. They've talked about this SBA One, which is to try and use technology to shorten that approval process. They certainly cannot compete with those lenders that I already mentioned. They can't compete with an On Deck, a Cabbage, a Can Capital, because it's happening in seconds, literally, versus, weeks. But we do help that business owner try, let's say, okay, if SBA is really a priority to you, maybe let's get a loan now. But we also want to be upfront with the lender that we're working with, saying, hey, let's do this loan now, but just know that this is a short-term bridge. When they get this SBA loan in, let's say, 60 or 90 days, they want to be able to pay this loan off and refinance, and actually go to an SBA loan. Right. So, we want to make sure that we're transparent about that process with our lender and the borrower, so everyone knows upfront kind of what's happening.
Right. Okay. So then it sounds like you work with a ton of different lenders. I mean, how do you decide whether or not to work with a new lender? I mean, there's new platforms in the marketplace lending space coming online. I mean, how do you evaluate the different lenders you work with?
Yeah, that's a great question. When we started Lendio, we started in the lead gen space. And we had over 300 lenders on our platform that we worked with that really, and our focus was just all about customer acquisition. As we have leveraged that expertise of knowing how to acquire customers into an origination platform, what we did is we took, those 300 lenders and we said, okay, who are the best-in-class lenders? And we created a scoring system that helped us determine how to define best-in-class. So best-in-class for us is based on 5 different things. One is we want to make sure they have a national footprint. So some of these lenders, if they're only going to offer loans in a state or a county or something like that, and it really limits the number of business owners in there, it's difficult for us to work with. So it doesn't have to be a necessarily a national lender, but it needs to be a regional lender or a super regional lender where they cover a significant footprint. The second is we want them to have technology that we want them to either have the technology or be open to work with Lendio to use technology to make that a very efficient and speedy process of underwriting. So that's part of our process. Third, we want to be able to have a great customer experience. So we want to know, we'll try that out. We'll have business owners where, let's say, we match that business owner up to that lender, and we do surveys to the borrower and say, okay, how was that experience with that lender? And if we're getting negative reviews, we don't want to be associated with that, and so we'll remove them from our list. Fourth is loan performance. So we care that these are lenders that know how to underwrite, and it's not kind of a fly-by-night lender that's just cutting their teeth trying to figure out how to underwrite the loan. And that's important for the borrower, it's important for the lender, it's also important for Lendio because we want to build a long-term relationship, and a lot of times these long-term relationships are built off renewals of the loan. And then fifth is, does it fit a loan gap that we might have? And what I mean by that is our approach is we want to cover the entire breadth of loan products out there, every type of loan you can think of, and across that entire spectrum. Well, we're constantly analyzing our data of business owners that are coming through our platform and saying, okay, who are the business owners that did not get any matches? And what are the common characteristics of those business owners? And then we try and identify with all these new lenders that are popping up, do these new lenders that are popping up, does their loan product match this segment of customers that currently isn't getting offers? I met with one last week. In fact, Street Shares, you just did a blog post about them.
Yep.
And they made an announcement of that $200 million financing they got to be able to fund more volume. Well, not only are they focused on their veteran customers, but there's a segment of customers that they're starting to add to their credit box that really fits a segment that isn't really being serviced very well. And so we're now starting to do, that process with Street Shares to be able to validate that those other 4 areas we talked about, that they can check those boxes, and then we'll add them in as a lender on our platform to send business owners their way. Okay,
great. So as far as the businesses go, you talked about restaurants, dry cleaners, whatever. Can you give us what are the main verticals that you're working with as far as those entrepreneurs coming to you looking for a loan?
Yeah, so it's definitely, this is a Main Street business. That's who we're focused on, Main Street business owners. And so, those industries and verticals, we can service anyone in the United States. The high segment of industries is, retailers, restaurants, manufacturing, wholesalers, kind of the medical, doctors, dentists, professionals. So, the way that we look at our space of who we can target, we look at, the characteristics of the business owner. And the only segment of customers that we don't really have options for is this combination of a business owner that is a startup and bad credit.
Yeah, that's a bad combo.
Yeah, bad combo. If they're startup, good credit, we've got options for them. If they've got bad credit, yet they've got some revenue in the door and they've been in business a little while, then we've got options for them. But for whatever reason, we cannot find a lender that wants to lend to a startup and bad credit customer. So,
right. That's fair enough. Okay, so I wanted to talk a bit about the deal that was announced, I believe it was last month, that you did with Staples. Now, you go to staples.com and there's a little button on their homepage there, which I know is obviously a highly trafficked page, that asks if you want to take out a small business loan, and that is all powered by you guys. So can you tell us how that came about and a little bit about what the relationship means?
Yeah, we are thrilled about this relationship with Staples. They have been just such an incredible team to work with, and we're excited about the partnership. So Staples, and I don't want to speak for them, so I'll just kind of say what's been publicly available. But they certainly are always considering new ways to be able to service their customers. And they've got millions and millions of business owners in their database that shop regularly online at staples.com or go into their big box store, the retail stores, and they're constantly surveying these customers. What are ways in which we can help you? What services can we provide? What products can we provide? And it became pretty clear through some of those surveys that small business owners, one of their biggest pain points was small business loans, or getting the access to capital for the financing they need. And so Staples decided they wanted to get into it in a big way. Last summer they did an RFP and they invited everyone to apply to try and win this deal. In fact, they said that they evaluated over 30 not only direct lenders but marketplaces, and it was probably about a 6-month kind of ordeal, and where they did a lot of diligence and a bunch of presentations. And we were very, very fortunate to have been selected and to win that deal. And we're very excited about it because they've got obviously a huge brand, trusted brand with business owners out there. We believe we've got the technology, the customer experience, the lenders, and the business model to really scale. And they, so for us, it was a kind of a partnership made in heaven. We're a few weeks into it. The volume is exactly where we were hoping. We're actually, it's better than we expected it to be, and we believe it's, we're just getting started. So that, it's a great partnership for us.
So I imagine, such a partnership would increase your business dramatically overnight. And as I said, it's been a few weeks now. Obviously, you're able to handle the volume that's coming in the door from Staples.
Well, we are rushing to handle it, and I'll also just, we've already have loans that are funded, and we've, today, in fact, we did our first customer testimonial video to a Staples customer that came through and was funded. But, one of the things that I'm excited to announce, to help us to be able to handle that volume is that we just closed this last week a $20.5 million Series C round. And we are very, very excited about that. And that certainly will allow us to handle the volume that comes through Staples. But in addition to that, we've got a few other partner deals that are in the works that could be similar in size that we hope to land as well. So that having a little bit of capital behind us certainly allows us and helps us to be able to meet those demands and scale the way we all want it to.
Sure. Well, congratulations on that round. That's great news. Can you share who was backing you in this round?
Yeah. So we have kind of a couple of groups that led it. We have Napier Financial Partners out of New York. These guys just led the Bill.com, the $50 million round that Bill.com led. They're very focused on fintech and a great partner. We have Blumberg Capital out of the West Coast, out of San Francisco. I believe they're in Fundbox. They are also very focused on, they're in Cognical, which is another fintech company, and very focused on financial services. Chris Scott Chalk from there. Pivot Investment Partners out of New York. Larry Klain, who used to be at Capital One and head of small business at Capital One, is in the deal. North Hill Ventures out of Boston, also former Capital One Ventures guys. And then our current investors are, Tribeca Venture Partners, that's there in New York, led the Common Bond deal and led the Shopkeep deal. Runa Capital, who's in Zopa, is in our deal, and then Highway 12 Ventures out of Boise, Mark Solon, who's been with us kind of from day one. So really good group of investors on board and believe in what we're doing. So.
That's awesome. That's great. So can you I'm interested in the typical, or the range, shall we say, because I imagine you get all kinds of different deals coming to you or people. What is the typical terms for the loans, the rates, the duration that you're getting? And does it differ between like what Staples is sending you and versus your other marketing efforts?
Well, that's a good question. I mean, there's so many different loan products that get financing. I mean, obviously there's certain loan products that just more customers are going to meet that loan product. So, for example, the cash, like the on-deck loan. On-deck has been a fantastic partner of ours, and because they're credit box, there's a lot more customers that will meet an on-deck loan than would meet an SBA loan, for example.
Mm-hmm.
So, if you take a look at the on-deck loan, or a loan similar to that, there's the cash flow loan or a merchant cash advance loan. They're going to be somewhere in the 6 to 12 month term with a buy rate of around 15 to 35 a buy rate, which obviously and then APR is going to be higher than that depending on the term of the loan. So there's that segment of customers, but then on the other end of the spectrum, you've got our asset-backed loans. So, and this is where the rates are lower and the terms are longer. So anything that's collateral-based, our commercial real estate loans, loan sizes are going to be larger, terms going to be longer. It's going to be more like 3 to 5 years, and rates are going to be anywhere between kind of that 5 to 10% rates. And anything with asset back, like an equipment loan, is going to be the same thing. Equipment loan is going to probably be a year to 2 years, anywhere from 6 to 15%, rates on those. So it's hard to say because there's so many different loan products out there,
mm-hmm.
but that kind of gives you an idea
Yep.
of the spectrum on one end to the other end, and then everything else in between our lines of credit, our term loans, our accounts receivable financing, purchase order financing. That's going to be kind of in between those two bucket ends that I referenced.
Okay, so then how do you make money, and do you make money the exact same way regardless of the lender that you're working with?
Yeah, so we make money when it's free for the business owner. We make money from the lender when the loan closes. So we take an origination fee as the loan closes. That origination fee will vary depending on the type of loan product. So an SBA loan may be, a 1 to 2% origination fee, versus maybe an equipment loan product, or a merchant cash advance loan product might be around the 5-6% origination fee. But that's how we make money when that loan closes.
Okay, fair enough. So then, obviously you're not in this market by yourself. I know we had the Fundera guys on the podcast last year. I know we've had Biz to Credit on. How do you differentiate yourselves from your competition?
Yeah, so we respect both Biz to Credit and Fundera tremendously. They're great organizations with very strong leadership, and I love what they're doing. I think this is an enormous market and allows room for all of us. A couple of differentiators. So the first thing with Biz to Credit, as was talked about a lot on your podcast, they're really starting to fund their own loans and, take a lot of those businesses that come in the door, instead of handing them off to lenders, they're starting to do that themselves, and, putting, I don't know if that's how the lenders view that. From our perspective, we don't ever want to be the lender. I'm not trying to underwrite the loans. I'm not trying to service the loans. We're not trying to kind of take that business and underwrite it ourselves. We always want to be the marketplace and make sure that we're not competing with that lender. So that's one of the differentiators with Biz to Credit. On the Fundera side, very, very similar business models. I think it's just difference in magnitude. We are many multiples the size of, as far as loan volume, and the number of lenders that we have on our platform, the number of business owners that are coming on our platform, and some of the other differentiators will actually hopefully be announced soon, maybe between now and or at Lendit. So I won't get into those now, but that's maybe the differentiator, is that just the volume that we have going through Lendio. Okay,
fair enough. So then there's something that, that I think seems like a big opportunity, and that is just the general awareness is still not quite there. Like if you go to talk to the average entrepreneur on the street and say, what are your options for a loan? Most of them are going to say, well, you can go down to my bank and find out what they say. there's still not the, shall we say, the awareness of the online options that companies like you guys. I mean, what is it going to take? Why is it still here we are in 2015 and people are not looking online first? And what's it going to take for them to look online first?
I think that is certainly happening at a very rapid rate just by seeing the size of the market and this alternative market as it continues to grow and expand. But as you mentioned, there is a tremendous amount of headroom. When you've dealt your whole life, you've ingrained your whole life to know that when I need a loan, I go to my bank. That's not going to just change overnight. Business owners believe, if I've worked my bank for 10 years, then the first place I'm going to go is my bank. It's just natural. And I think bank, and I think lower rates, and I think, that I'm going to get financing. But what's happening is that especially since the recession, banks are moving upstream. Banks are focusing on loans larger than $1 million, where they can use loan committees. They can take 30 or 60 or 90 days. They don't need to use technology to innovate. And it only takes one time for that business owner to go to their bank and spend 26 hours filling applications, or to have the loan officer say you're not a good fit for us, or getting declined 90% of the time. That tastes and feels, it hurts. And then they start to say, wait a minute, there's got to be other options out there. And so I think we are seeing that trend. And I think that as business owners, they might read about it, or they might hear about it, or they may be oblivious to it, and they just automatically think I'm going to go to their bank. But I think the rate at which it's accelerating is pretty impressive, considering that this alternative online lending space has really only been had the attention it has had, over the last maybe 5 years. And so, I see that, and the other thing, let me just add a second point to that. As so many of people in the online lending space have raised capital, and they've got dollars to go out and spend for marketing. We're starting to see radio, we're starting to see TV, direct mail has been very strong for years. Business owners are starting to realize, whoa, there are other options out there. And I believe this is, that rate in which business owners are going to go directly online looking for that loan will continue to accelerate until I think we're maybe 5 years out or so where it'll be mainstream at that point.
Yeah, no, I tend to agree with you. I think that's it's happening slower, it seems like, in the small business space, but I think it's small business owners are more ingrained with, they all have a long banking relationship. So I think it may take a bit longer, but fair enough. So anyway, I got to let you go, but one last question. You've got yourself a nice amount of cash in the bank now. What's the future hold for Lendio?
Yeah, we are incredibly excited about the market. We're excited about how we're positioned. We're excited about that trend that we just talked about. If you think about marketplaces in any industry, whether that be marketplaces for, airline travel, you've got Kayak, or if it's marketplaces for restaurants, you've got Yelp. Marketplaces for hotel, you've got, a Priceline. What has happened with these marketplaces is that there usually becomes one or two and maybe three winners in the market. And so, from our perspective, we believe it's an enormous market. We believe that it will only get more and more confusing for the borrower. That you can only get so many direct mail pieces in your mailbox before you start to get confused. And what is the difference between all these lenders? I can't keep up with all of the unique nuances between all these different lenders and loan products, where that business owner is going to want to go somewhere and say, you help me figure out which loan product is the best fit for me. Help me know what's the difference between Cabbage and On Deck or Can Capital, and help me compare and contrast. And so from our perspective is we're positioned well. We care a tremendous amount about our customer, the borrower and the lender, and it's an opportunity for us to run and to run fast. And so, that's where we don't want to be a lender. Long term, we want to be that marketplace that is providing a great borrower experience for that business owner to get the financing they need.
Okay, well put. Well, on that note, let's wrap it up. So, very much appreciate you coming on the podcast today, Brock.
Yeah, thank you, Peter. Really appreciate you having me.
Okay, we'll see you later.
Bye-bye.
You know, I have to agree with Brock, and I actually think that small business lending is going through a transformation right now. It's going to be more change in the next 5 years than we've probably seen in the last 50. You know, when I was shopping for loans like 15 years ago and I needed a loan for my small business, it was the bank or nothing pretty much. And, you know, I actually did some loans on personal credit as well through credit cards, but the options just simply were not available. They are today. It's a great time to be an entrepreneur. It's a great time to try and fund your business. There are just lots of options. And I think over the next 5 years, you are going to see entrepreneurs gravitate online first. I think you're going to see all kinds of lenders do well, from the on-decks, Can Capitals, through to Funding Circles, Lending Club, and the SBA lenders. I think we've got a changing landscape here, changing demographics, and I see a company like Lendio very well positioned to do well in the future. Anyway, on that note, hope you enjoy the show, and thanks for listening. We'll catch you next time. Bye.